Back in 2019, short-term rental company Sonder was valued at $1.1 billion, positioning itself as a high-end alternative to Airbnb. But just 6 years later, the San Francisco-based company has abruptly shut down. On Monday, Sonder announced it would immediately cease operations and soon file for bankruptcy. The closure came suddenly. On Sunday, the company lost a key licensing agreement with hotel giant Marriott. After a rushed search for alternatives, Sonder ultimately entered Chapter 7 liquidation. By Tuesday, numerous reports described guests being forced out of their rentals mid-stay, while employees abruptly lost their jobs. Interim CEO Janice Sears said in a press release, "Liquidation is the only viable path forward, and we are deeply disappointed," adding that the Marriott partnership had suffered from delays and unexpected costs. "We explored all feasible alternatives to avoid this outcome," Sears continued, "but we had no choice other than to immediately end operations and liquidate our assets." The sudden move affects Sonder's network of apartments, hotels, and rooms worldwide. According to one report, as of the end of June, the company managed 8,300 rental units. Although most travelers reportedly received refunds, some lost bookings have cost people hundreds or even thousands of dollars in additional travel expenses. The shutdown has been even harsher for employees. As of last December, Sonder had 704 employees in the US and 717 abroad. On Monday and Tuesday, laid-off workers flooded LinkedIn with posts about the company's sudden collapse, asking for support in their job searches. One California payroll manager wrote that she had to process all U.S. employees' final paychecks with just 1 day's notice. It remains unclear how many employees lost their jobs in the shutdown. The bankruptcy proceedings are expected to reveal more about Sonder's final downward spiral, though signs of trouble had been apparent for years. Co-founder Francis Davidson wrote on LinkedIn in June that before the pandemic, the company was like a rocket ship. Former San Francisco Mayor Mark Farrell, whose venture capital firm had invested in Sonder, called it his most successful investment in 2021. But like many startups, COVID-19 changed everything. With business travel down and downtown cores emptier than before, a full recovery became impossible. Davidson wrote on LinkedIn, "Sonder's rapid growth and downtown presence turned from an advantage into a heavy burden." The company laid off staff, abandoned planned leases, and eventually closed all its San Francisco locations. In early 2022, Sonder made headlines by going public through a SPAC merger, raising hundreds of millions at a $1.9 billion valuation. But Davidson later admitted that move was unwise. With no profits to show investors, Sonder's stock plummeted throughout 2022 and continued to fall afterward. Its partnership with Marriott, which listed Sonder units on Marriott's booking platform, failed to provide sustained momentum. In its latest financial filing as of June 30, Sonder reported $1 billion in assets, $1.4 billion in liabilities, and a net loss of $101 million over the previous 6 months.